All right, let's jump right in. Today we're putting the semiconductor powerhouse AMD under the microscope. But here's the deal. We're not going to give you our opinion. Instead, we're going to use a checklist, one inspired by, one of the greatest investors of all time, Warren Buffett. The goal here is simple, to let the data tell the story. Is this a great business? Is it a great stock? Or maybe is it both? Let's find out.
First up, I want you to just look at this number, let it sink in. Over the past decade, AMD stock has returned nearly 10,000%. That is just a mind-blowing number. It's the kind of performance that can truly change lives for investors who got in and held on.
But of course, a number like that forces us to ask the single most important question you can ask today. After a historic run like that, is the price you'd pay right now still worth it? To get to the bottom of this, we're going to follow that Buffett-style logic and break it down into two really simple questions.
So question number one, and this is the absolute foundation of this whole way of thinking. You have to forget about the stock price for a minute. Just push it out of your mind. The question is AMD the business a great business? Let's see what clues the data gives us.
The first clue of a great business is pretty straightforward. It's growth. And boy, has AMD been growing. Just look at its revenue. Over the last 5 years, it's been compounding at almost 29% a year. But get this, look at the last 12 months, it's actually accelerated to over 34%. This is a company that's clearly firing on all cylinders. Okay, next up we want to know how efficiently the company is making money. And for that, we look at something called return on equity, or ROE. The easiest way to think about it is this. For every dollar that owners, the shareholders, have put into the business, how much profit does the company spit out? It's a fantastic measure of how good the management team is.
So AMD's ROE clocks in at 6.88. What this tells us is that, yes, the company is pretty good at using its owners' money to make more money. It's a really solid sign of an efficient operation. So that's another big checkmark in the great business column.
Now, here's a crucial piece of the puzzle. How is the company paying for all this amazing growth? Is it taking on a mountain of debt? Well, this number is the debt-to-equity ratio, and AMD's is just 0.05. I mean, that is an incredibly low number. It tells us the company is funding its own expansion, not relying on banks, and that is a massive sign of financial strength.
So, let's recap our first big question. We've got explosive revenue growth, we've got solid profitability, and we have very, very little debt. The numbers here are pretty loud and clear. From an operational standpoint, AMD looks like a really high-quality business. But that's only half the story.
We've basically established it's a great company. But now we have to ask the second and just as important question, what's the price? Because, as the saying goes, even a wonderful business can be a terrible investment if you pay too much for it. So now we stop looking at the company and we start looking at the stock.
Okay, so here are a few common ways to see if a stock is cheap or expensive. And whoa, that price-to-earnings ratio, the PE ratio of over 131, just leaps off the screen. The other metrics here are also pretty high. Right off the bat, this suggests that the market has some incredibly high hopes baked into this price. To put it bluntly, it looks expensive.
But let's dig a little deeper. Is it just expensive compared to other stocks, or is it expensive even for itself? Well, when you compare its current PE ratio to its own average over the last year, you can see it's significantly higher. So this tells us that investors aren't just paying a premium for AMD, they're paying a bigger premium than they were even recently. And this leads us to our final and maybe the most important test in this whole framework, the margin of safety. I mean, this is the absolute bedrock of value investing. The whole idea is to find what a business is really worth, its intrinsic value, and then try to buy it for a lot less, creating a buffer, a margin of safety.
So, how in the world do you figure out what a business is really worth? Well, one of the most common ways is something called a discounted cash flow analysis. It sounds complicated, I know, but the idea is actually pretty simple. You try to guess how much cash the company is going to make in the future. Then you calculate what that future money is worth in today's dollars, and voila, that gives you a fair value estimate for the stock.
So what happened when we ran the numbers for AMD? Well, according to this DCF model, the fair value price is about $205 a share. Now compare that to its recent closing price of nearly $348. That is a pretty big gap. And that gap gives us this number, a negative margin of safety of nearly 70%. What this model is telling us is that the stock isn't just trading without a buffer,
It's trading far, far above what the model thinks its intrinsic value is. It's the complete opposite of a margin of safety.
Okay, let's take a step back. Where does all of this leave us? We've looked at the business and we've looked at the price, and what our investigation has really done is uncover two very different, almost conflicting stories. Let's put them right next to each other. So, on one side, you have the data that paints a picture of a wonderful, high-quality business. It's growing fast, it's profitable, it's financially rock solid. But on the other side, you have data that shows a stock price that looks extremely high, stretched way beyond its own historical norms, and way above its calculated fair value.
And that right there leaves us with the ultimate investor's dilemma, which this question captures perfectly. Is AMD a wonderful company that is currently trading at a not-so-wonderful price? The checklist has done its job. It's shown us the conflict in the data. Now, deciding if that high-quality business is worth that high price, well, that's a question every investor has to answer for themselves.